How do you think about risk? The Canadian investment industry regulator recently adopted a two-pronged test for retail investors. The tests are risk tolerance, how much risk can you psychologically withstand, and risk capacity, how much loss can you financially withstand. Many people may have reasonable definitions and tests for both these metrics, but neither one offers a clear, objective measurement that can be applied across the board for all investors at all firms. In other words, standards are whatever each firm says they are and could vary wildly from one firm to the next. Thus, these two crucial tests are all but meaningless since generally accepted measuring sticks don't exist. Now, part of the problem is that certain products are rated on a consistent basis while others, as well as individual securities, are not. So for instance, mutual funds and exchange-traded funds are offered via prospectus, which carries a consistent risk rating that's consistent between firms. Individual securities, however, can be rated differently at different firms. While nothing is ever certain, it's generally agreed that products holding 30 or more securities in a single basket offer more diversification and are therefore less risky than the individual components of that basket. Let's not forget that as recently as 2023, approximately 25% of the return in the S&P 500 came because of a two-tiered market. The so-called Magnificent Seven stocks accounted for about two-thirds of the total gain, while the remaining 493 stocks accounted for the final third. The overall market is deemed to be at medium risk. It stands to reason, therefore, that many stocks that used to compose that index are riskier if purchased individually. The components of the market that explain most of the return also explain most of the risk, since risk and return are related. Those investments that go up most quickly are the same as the ones that could drop the most quickly. There are 5 categories of risk: low, low to medium, medium, medium to high, and high. Clients need to allocate percentages to each of them, and advisors and their firms need to stay within those guardrails. I found that 5 of the Magnificent Seven are rated as medium at my firm, while the other 2 are rated as medium to high. None of those stocks are rated as high risk. Once again, different people have different tests and they might be applied. I don't know how other firms rate these different securities, but I suspect that the ratings are similar across the industry. The most likely methodology would involve an equity waterfall, provided by a risk management software company where various metrics are applied and risks are assigned. The metrics include price, market capitalization, relative turnover, midpoint price, and yield tests. These tests, in my view, often lead to ratings where large and growing companies are not flagged as being risky. That lack of risk management and proper security assessment is madness, in my view. One of the most widely accepted metrics is the price earnings, or PE, ratio of a stock or stock market. Today, the PE ratio for the S&P 500 is around 28. As such, any stock with a PE ratio over 28 might be deemed as being expensive or risky relative to the market, and any stock with a PE ratio under 28 might be cheap relative to the market. For context, the PE ratio for the S&P 500 has historically hovered below 20, so a PE ratio of 28 is already objectively about 40% more expensive than the historical average. Expensive stocks are risky because when the price reverts to the long-term average, those that rose the most are also going to be the ones that fall the furthest in all likelihood. To me, any security that has either gained or lost 40% over 365 days or has a PE ratio of over 40 should be rated at least medium to high risk. And any security that has gained or lost more than 50% over 365 days or has a PE ratio of over 50 should be rated as high risk, with no exceptions. Next, let's look at Robert Shiller's CAPE ratio, which is the cyclically adjusted price-earnings ratio that currently stands at about 38. For perspective, it hovered at around 30 when the stock market crashed in 1929. I worry about industry bullshift. Bullshift is a word I concocted to explain how the financial services industry keeps people feeling bullish by shifting their attention to optimistic narratives that may have little to do with any kind of a basis in reality. Minimizing the risk an investor might take is part of it. Everyone wants to make money, and as long as the bulls are running, people tend to suspend their disbelief and continue buying on the expectation that markets will continue to rise. That's sometimes called greater fool theory. Where traditional theory would say buy low, sell high, greater fool theory will say doesn't matter if you buy high as long as you're confident you can sell for something that's even higher. It should be obvious that a buy high, sell higher approach is riskier than the traditional approach. I can't help but feel that sense of foreboding when I see commentators suggesting we can avoid a bout of stagflation. In reality, we'll all be left with a stark choice. Keep rates higher to keep inflation under control, or risk inflation running rampant in a Hail Mary attempt to provide stimulative economic activity that would stave off a market downturn and an economic contraction. The narrative is promoted by certain segments of the industry that want to keep investors happy, docile, and optimistic, rather than worried and inclined toward critical thought. In short, optimism is good for business. And I'm not opposed to optimism in principle. It's just that I prefer realism. Here's some more perspective to chew on in this expensive market that is fraught with potential minefields. In the 5-week drop in February and March of 2020, the NASDAQ index fell 38%. Does that seem risky to you? Does it dovetail with your risk tolerance? More recently, on April 29, 2022, Amazon stock experienced a one-day drop of 14%. Does that seem risky to you? How does it dovetail with your risk tolerance? Going back to semi-recent history, remember that recency bias causes people to become complacent as past white-knuckle experiences fade from memory. In the period from February of 2000 to August of 2009, that spans 9 years and 7 months, the S&P 500 saw a peak-to-trough drop of 54%. Within that window, the global financial crisis of 2007 to 2009, the S&P 500 saw a drop of 56.8%. Does that seem risky to you? How does it dovetail with both your risk tolerance and risk capacity? Are you sure you could stay the course if something similar happened today? In the late 1980s, the Japanese large cap market, which is called the Nikkei 225, was trading at an incredible multiple, 70 times earnings, having been at only about 20 times earnings at the beginning of the decade. The Japanese market hit a peak at the end of 1989 and began a painful and prolonged drop. It took over a third of a century to recover, having only hit new highs in the past couple of years. So for those of you who claim to have a long time horizon, how much time do you have really? Do you think many people have the risk capacity to wait even one third of a century, even 11 years, for their original investment to get back? I call bullshit. I've seen new client application forms suggesting that the longest time frame to recoup one's money is more than 3 years as an option. In truth, virtually any portfolio, and certainly any balanced one, often needs longer to reclaim previous highs. In other words, unless every client opts for the maximum possible time horizon to recover, investors, advisors, and advisory firms are all guilty of overstating risk tolerance and risk capacity. Bear markets haven't been eradicated. I've been expecting both a bear market and a recession for years now. And I'm convinced that whatever happens, people won't be ready for it and will claim that they were groomed into taking more risk than they really wanted or expected. They'll only be partly correct. Mirrors will be needed too. If clients end up selling because of a major sell-off, their advisors should be held accountable for their role as well. It seems as though the industry will have some blood on its hands, and other stakeholders, regulators, product manufacturers, and product distributors will likely try to blame the advisors. There's little doubt we all have a daunting task in properly codifying and identifying sources of risk. Advisors are the ham in the sandwich. They're merely constructing portfolios based on unreasonably optimistic ratings set out by the industry. And in this instance, optimistic means unwilling to properly rate risky investments as such. To make matters worse, risk tolerance and risk capacity are heavily biased in favor of recent experiences. The challenge of recency bias means that if markets have been going up lately, people are often inclined to take more risks than they might have otherwise taken because they're lulled into thinking that the recent past is a prologue to what lies ahead. Then, if something bad happens, many are unlikely to have seen it coming, and they do so simply because they hadn't experienced anything similar to it recently. Please, revisit your risk profile and associated portfolio holdings immediately. My guess is that most people watching this are taking more risk than they want because they're taking more risk than they realize because the industry makes more money when investors have a risk-on mindset. It's your money and your financial well-being. Please take it seriously.